Why do banks lend you money? Why do they lend us money? How often have you paused to think why they want you to take a loan for a car, for a house, for a wedding or a model, college, take a new credit card out, open a 0%? Why? Every financial decision that we make, whether it's saving, spending, or investing, comes with hidden trade-offs, like everything in life, that most of us overlook. In this webinar, we're going to explore these trade-offs through relatable analogies, like the leaky bucket and the toll road versus the freeway. And together, we're going to break down how infinite banking empowers you to keep your dollars working and building a more secure financial future. So let's dive in. So it's often framed as opportunity cost. The opportunity cost is usually talking about loans and debts, but it's actually woven into every financial decision, from buying a home to saving cash under the mattress, as Dave Ramsey and Susie Orman suggest that we all do, which we all know, if you understand opportunity costs, that money under the mattress becomes less and less valuable every day. So in this toll road versus the freeway analogy, think of two routes to a destination. What happens with the toll road? And please participate, put your answers in the chat. What happens with the toll road, right? When you get on the toll road, what is the trade-off? You get there faster, but what's the trade-off? You pay. That's right, Derek, you pay. The toll road gets you there faster most of the time, and it can be more convenient in the short term, but the long-term consequence is you're paying, and every time you use it, you're adding up and you're paying someone else for the use of that road. You're already driving on it. And if you might be thinking, but Jason, I get where I'm going. So what's your point? What's the solution? The solution is, let's learn how to build our own road. That could be efficient, that could be cost effective, that could be sustainable. And over time, all those tolls, all those nickels, dimes, quarters that we're giving away to other people, all of a sudden, we're keeping them in our own family. We're keeping them in our own family. And when we only think about opportunity cost in terms of debt, then we're missing multiple other parts of the financial picture. Some of us are savers, some of us are spenders, some of us only save and then spend cash. There's all different types of ways that people are using money, but our question, the reason we're here, is what is the most optimal use of the money? Not right, not wrong, but what's going to work best for you? What's going to give you the most bang for your buck? We're trading our time for money, right? The first business, the first job we all have to be in. Both the calls I had today, one person makes money and saves like 80% of his money. Doesn't have a lot of overhead, doesn't have a lot of costs. He's really learning in the last couple of years how to be an entrepreneur. And the last person I talked to has a huge heart, helps tons of people, will literally walk door to door and knock on the other 97 houses in her community to share this information once she proves to herself that it works. But she's not saving yet. So make a mental note for yourself. Where are you? Are you someone that's already paying yourself? Are you making enough money and spending less than you make? And then how are you spending the money? How are you financing the things in your life? And remember, we finance everything we buy. We finance everything we buy. And you're thinking, what do you mean, Jason? I don't finance things. I pay cash. Well, when you pay cash, will you ever earn money on that money again? Hello, Emmett. Will you ever earn money on that money again? Pop it in the chat, yes or no. The opportunity cost is everywhere. It's like choosing between this toll road and the freeway. The toll road might seem the quickest solution, but those fees over time are going to add up. And you guys know the answers. I love that you're here every week. It is the repetition of this information. It's not new. I'm just telling old stories to new people and to the same people, and you guys are learning this by the repetition. Now imagine, like I said, building your own road, one that pays you back every time you drive on it. And that's what makes infinite banking, or infinite banking makes that possible for you. And who here pays cash? We got any cash buyers in the in the crowd? Anybody go out and pay cash? Write an I in the chat. Don't be shy. This is ingrained in our money pattern and thoughts. Does anyone? Shane says, no, thank you. Frank says, nope. So you don't pay cash. I have cash right now. Look, a little bit of cash in my wallet. Not much, but there's a little bit. Received it for the holidays and just haven't deposited it yet. But when I like people who pay cash for one reason, because one, there's an opportunity to help them do something, because out of the two pains in life, the pain of regret or the pain of discipline, they're already picking discipline. They're saving over time. So while they're saving money, is their money earning them anything? It could, maybe in a high yield, maybe it's earning them 3.5%, 4%. Dexter says he pays cash. Okay, Dexter, name some examples of why you're paying cash. What are you paying cash for? Are you paying cash because you're taking a loan from your policy and then you're, using the cash from that and then paying yourself back with interest? Or are you really just paying cash? And so, because when you're paying cash, we're not playing the game. Now, there's nothing wrong with it. Again, I'm just pointing out that if we're going to play the game that's set up, and we have to understand the rules. So if you're someone saving, let's say you're saving for that new car, and over a couple of years, you've saved 10,000 or 25,000 or 50,000 or 100,000. When you purchase that car, or maybe you purchase a new boat, maybe it's a pontoon party boat. I don't know. Maybe you guys like to party. And now you're taking all your friends out on your 12-person, 14-person party boat with an upper deck that you're jumping off into Lake of Ozarks or whatever, like maybe Brent Kessler was back when he was a chiropractor. And you've paid cash, and now you'll never earn money on that money again, right? It's not growing in a bucket where it's like in this cup where it's guaranteed to grow over time forever and increase every single day from the moment you make a deposit into it. And then you're depositing it for your whole life. Remember, all of the mutually owned dividend paying whole life companies that we work with, they're not willy-nilly. They're only betting on one variable. I'm sorry to break this to you guys, but guess what? We're all going to graduate someday. Yeah, we're going to die. So one day we're not going to be here. So the way that we're spending our money, let's think long term. Let's go ahead and Dexter put sometimes a larger spread, sometimes where they not accept credit cards. Okay, reasonable answers. Yeah, when you go to maybe a concert and you have to pay for parking and you weren't able to pay ahead of time, you might pay cash. It's a good point. And spending cash feels safe, but it's losing that compounding growth. It's losing the guaranteed death benefit for your family. And I look at that as like the leaky bucket. Anytime that we're either not earning interest on our money and we're paying cash for it, or maybe we're paying interest to someone else, those are leaks in our financial bucket. And that's what we're looking here today. So all of you make a note where you're at today financially, and maybe where is some of the leakage? Where are some of the places that you're either paying cash, you're paying interest to somebody else, that you could recapture or recycle that and bring that back to your family through the system that we teach. And so let's bring this leaky bucket analogy to life. And we talked about how paying cash for big expenses can hurt someone and their family over the long term. It's like every dollar that's leaving is like water escaping from your bucket. Even if you're refilling it, the leaks mean you're constantly losing potential growth. Like imagine all the money you're making flowing into that bucket on the screen, and now you have big holes on both sides and they're just falling out. Unless you're patching those holes, keeping that money in that bucket where it grows. Again, this is like the toll road where the nickels and dimes and quarters, they're adding up over time. And as we're earning the money, guaranteed growth, if we get a dividend, now you're sprinkling some more cash back into the bucket, and that's going to do what? It's going to grow the cash value. It's going to grow the guaranteed legacy you're leaving, and it keeps growing uninterrupted, and you have access. So you've basically turned the $1 that you've deposited, and now you have 3 uses for it. It's growing uninterrupted in here, it's guaranteeing your family here, and you have access to it, liquidity, if you need it. And so remember a time that you paid cash for something? Have you ever faced a situation where you're about to pay cash, but you chose to leverage your policy instead? Have any of you done that yet? This happened to me when I opened our fourth policy. It was literally that exact moment when Uncle Sam, and you've heard me tell this story, when Uncle Sam came and said, "Hey, Jason, congrats. You've been approved for an S Corp." And Patty and I were like, "Woohoo! Yes, awesome." And then he's like, "And I need my payroll taxes. I need 40 grand, 20 in December and 20 in January." And the first one, I didn't have a plan. I had leveraged our first three policies. We had paid off debts. We had paid ourselves back. We had went on a vacation and we were paying it back. And we didn't have 20 grand in our policy, but we were putting the money aside for our business in a business account because we knew we'd have taxes. And I thought about it and I rethought my thinking. And guess what I did? You guys know the answer, but pop it in the chat. What did I do other than get down on my hands and knees and pray and say, "Oh man, what should I do, God, in this situation? I got this big bill. I understand that when I stroke a check and pay Uncle Sam this 20 grand for our payroll taxes, I'll never earn money on the money I've already earned. That was our money. Like we worked hard for that money. We went and served and helped and thought and taught and made sure that other people were getting what they wanted to earn that money and have it come into our life in the first place. And now here I was doing something I promised myself 3 years ago I would never do again. I was making someone else rich, and it was never going to help my family and the legacy I was creating for my boys. And like Sandra just said, I opened a new policy. I said, okay, I stroked the check for the first one, sent it to Uncle Sam, got pretty mad about it, and thought, well, what's the solution? Well, the solution was to take the money we had been recapturing from our debts and paying ourselves every month from the 10 debts we had paid off at that point, and the money that was sitting aside for our taxes, because we were also prepared for that, not knowing exactly what they would be. And so we started the fourth policy. Now, as you know, when you first start, you don't have full access, but I set it up in a way where I would have the long-term growth I wanted. That 10-year mark was going to be where I wanted to be in 10 years from now. And it let me pay that $20,000 bill due in January. But this time, all of that new money was in a new policy where it's growing at a guaranteed 3.25%, where it gave additional death benefit on my body, protecting both my boys and my wife and the people I love more. And that was the outcome. And so if you guys have any examples like that, share that in the chat. I see you guys are active, which I appreciate. It's awesome. And so let's look at this. How many of you in the audience today are business owners? Give me an I or a me. How many of you guys are running a business? Shane, yes, sir, Derek says. So let's look at the most optimal way. Oh, we got Gabe. Welcome, Gabe. I'm glad you're tuning in today. So if we're business owners, Gabe's a business owner. I'm a business owner. We got Shane and Frank and Dwayne and Jay. Look at all the business owners. So far we've talked about paying for cash for things in our personal life. We've talked about the toll road versus the highway and building our own road. And now let's just look at it from a business sense. Let's look at the decisions in capital efficiency. If you're a business owner, there's so many opportunities to use and leverage a specially engineered whole life policy to keep more of that money in your family. And a lot of times what I've noticed in the calls I've had is people look at the biggest numbers first, where they're hurting the most, where they're paying the most, but they're missing the little opportunities. Maybe it's a copier, maybe it's a smaller piece of equipment, maybe it's a remodel. Maybe it's a restaurant owner that's going to remodel their kitchen or upgrade the kitchen for $30,000. And so if you go out and you pay cash for these things, or maybe you're buying a new vehicle. I just had a guy start a policy that owns multiple pharmacies in Indiana call me up and like, Jason, I just bought 2 cars. I just read Nelson's equipment financing section. I just bought 2 Toyotas, 2 Corollas for 25 grand. I have the money, but the way that we purchased them, we did something wrong. And now like I'm stuck paying these back from my personal account instead of through the business. So could we start a policy where I could recapture that? And I was like, of course we could. Sir, of course we could. And so that's what we did. And that I love having that starting point. And he actually said, if this works, the way that you guys talk about it, if it's as simple as you say it is, just go through underwriting, get approved, fund the policy, get introduced to my student driver, my implementation specialist, take the loan out, and now I can pay back the vehicle and pay myself back. I think his payment on the two vehicles was $600 to $700 a month. So he's going to recapture that six or $7,200 to $8,400 a month back into his pocket that would have been financed. And remember what I said at the beginning? Why do banks want us to finance things? Why are there so many advertising about like the freedom you get by getting what you want through a 0%? Man, that's a load of hooey, keeping it clean for all the kids. So take the example of 20K to explain you start a new policy to pay that bill. Sure, Sean. So with this, I'll use it for the business owner. So being a business owner, you can look at it as renovations, equipment, expansions, even taxes. You know, if you're going to store and you know every year your taxes are roughly the same, and you're going to store the money in a savings, like you're going to put 30% aside of the income that's coming in for the business, and you're going to store it somewhere. Well, where are you storing it? Are you storing it in a regular checking or savings account or maybe a high yield? And then when the tax bill comes, you pay Uncle Sam. What if instead you took the money that you know that every year it's going to be about the same amount, or you're growing, so it's going to increase over time, and now you're creating a policy to hold that amount. Like one of the things that Patty and I are talking about, this is a little crazy, but I'm going to share it here, is we watched our insurance, our for ourselves, our health insurance go up by $3,600 this year. And like when she called to make an appointment today for something that she needs, the first available was May. I'm like, May of this year? Like, that's nuts. You can't go any sooner. And they say, oh, you can see another doctor in the end of April. And so we're like, well, why don't we just start a policy for the things like other than taxes, maybe for our insurance, for other things. And over time, you build enough of your system, your warehouses of wealth, so you can finance all of things. So hopefully that makes a little bit more sense, Sean. So you can open a policy with 20, you can open a policy with whatever amount that you have that you're saving. It's really where are you at? It really depends on what you're trying to achieve, both now and in the long term. And so, like, I'm giving a couple different examples here, and hopefully you guys are following. But like, let's say a restaurant owner, like I use the taxes that we use and how we actually use it for a policy. I talked about what we might do in the future. But let's say that restaurant owner, or let's say, you know, Gabe with his jujitsu studio, right? His six blade studio says, hey, I'm going to upgrade the studio, and I'm gonna do it with $30,000 in cash. And he has the money there, and he pays all the contractors to do it, like he showed us in one of the examples in the 9-week course we did. Now he's able to give a better quality of service and atmosphere and training to his students. He's able to increase the amount of students he's had, which increases the cash flow, increases the business. But if he paid cash, he has that financial leakage. It's money leaving the bucket. Instead, you know, Gabe takes one of his policies. He's storing the money in his policy. He takes the loan out. He's now guaranteed growing the money in his left hand. It never gets interrupted. He's paying back the insurance company because he has a plan. He's an honest banker. He's an honest business owner. He's paying back the cash that he borrowed from the general fund. And he also has the growing death benefit for his kids. And so now this business capital he had is working in two places. It's funding the growth and it's compounding behind the scene. And so, you know, with business owners, the opportunity because of the amount of money moving through our system is huge. Your capital, your business, like if you're not growing, you're what? If you're not growing, you're dying. So you have to be able to go out and think of what is the most optimal, back to the wording. It's not right, it's not wrong. What's optimal or suboptimal? It's either the best it could be or a little bit sub. And we're going to make mistakes at times. You guys got to have to give yourselves grace. Someone asked me that the other day. Say, Jason, well, what if you don't get up and do the said things you said you were going to do? What if you don't get up and train because it's freezing out, or go out and get in the cold plunge or do those things. And why am I going here instead of banking? Because it's all about our behavioral patterns and how we treat ourselves. In the past, I would have beat myself up. Like I would have went and missed the dinner to go do the training I hadn't done and stay out and miss putting my kids to bed and made sure that no matter what, I'd stay at the gym until it closed or to get the stuff done, to get the swim done, to get the lift done, to get the stuff done because I had this thing. If I miss, I'm not doing what I said I would do. And I want to keep that integrity. But what I've learned, it's better at times just to give yourself some grace. Say, hey, what's the lesson here? Did I not prepare the night before? Did I not prepare, for the example of doing a renovation? Did I not prepare that at some point I'm going to want to expand? Was that not in my vision? Did I not see that, hey, this capital is going to cost at some point to expand? And if we want to keep growing, we're going to have the leverage, right? And that's why we're creating the policy, because maybe we're not using it right now, but maybe 6 months or a year or 2 years from now, we're going to expand, or maybe we're going to open another, Gabe will train another instructor and he'll expand Six Blades, his location, and have two of them now and be able to serve twice as many people and teaching them self-defense. And so the key here, you're hearing it, is not only our mindset and how we treat ourselves, and understand that when we make a mistake, it's a lesson, nothing more. It's a nothing more. And the key here is steady, reliable growth while having the vision for the kind of scale that you desire. And it has to be your desire. Don't look at what someone else is doing. Don't go, pull like, hey, I want to serve millions of people because that's your big, hairy, audacious goal. Maybe that's yours, but maybe your goal is a little simpler. Maybe you're just like, you know what? I want to spend more time with my family. I want to have more fun in my life. Build your business and your life around your life versus building your life around your business. That's something that was brought to me in one of the books I'm listening to right now. And so this is just a way that business owners can leverage this. So not only personal, but business owners can leverage IBC to have their money working in multiple places. And I just kind of showed a couple different ways of how a business owner paying cash for that renovation would drain the account, would get nothing in return, no death benefit, none of the other things, versus having the growth continue guaranteed, protecting the family, and paying it back with a little bit more flexible terms. And Gabe, I'm glad you're here because here's a real life example. For Gabe expanding his business, I actually took, and Gabe, hope this is okay. I know I didn't run this by you, but I wanted to show you the cost of capital. We're talking about opportunity cost today. So two of my partners, right? Gabe, who's here, who we did the Black Belt Boot Camp with, and Jeremy Huggins, my co-host for Wealthwise Banking, which is a new podcast we just launched, and I'll share with you guys here shortly, are both real estate investors. They understand the strategy of building their foundation first over time, having the discipline and the long-term vision while avoiding traditional debt, while avoiding taking loans from the bank when they can, which maximizes their capital growth potential. And so Gabe, used this policy, created a new policy to make this purchase, to put the down payment on this purchase. And now Gabe's plan is multifaceted, but if you look, it's a $679,000 purchase. He talked about it a few times, his farm. And he talked about he's going to move his jiu-jitsu studio here eventually. He's got family members there. So he's got a lot of different variables. But if you look, this is a 30-year mortgage. So look how much opportunity cost is wrapped up for the banks. Remember the first question? Why do banks lend you money? Why do they lend you money? They lend you money because it's profitable. It's crazy profitable. You see the annual loan percentage of 8.385 is actually over 30 years, the total interest percentage, can you see that, is 164%. That is the actual hidden cost. That's that amortized math that I talk about being the devil's math. And I say that, but I really believe this is what we're teaching you is how do you take back control? How do you leverage the opportunity for your hard work And it doesn't cost you anything. It's not costing you more work, more time, other than investing this to learn the skill. There it is. The volume is what matters, because over those years, like Gabe just said, that 8.35%, that monthly payment, actually ends up being a volume of 164% and change. 164%, 8% to 164%. Anybody here want to make 164% over the lifetime of a deal? That'd be pretty sweet, right? You guys would say it's too good to be true. You want to get your attorney involved, make sure that that is all vetted. And so over time, Gabe will, through growth of the business, making more money, adding more value, adding more policies, he will eventually take ownership of this, and that'll be a super solid investment. Sandra says, be the bank. That's it, BYOB. And so when you're doing this, some people too, another thought I had is when you're doing this, we get, like, we just funded another one of our policies, the one I was just talking about, for the that we have set aside for the taxes. And my immediate thing was, let's keep that money moving, right? Because why? Because money in motion does what? It makes more money. And then I thought about it. I thought, wait a minute. Connor asked me the other day about the recession. I said, Dad, actually asked Patty, what's a recession, Dad? And we explained it to him. He said, do we have to worry about it? And I said, 4 years ago, yeah, we would be a little bit more worried. Can we be concerned? Yes and no, because we've done things to make sure that we've insured our family and protected ourselves, and we're putting so much of what we earn into our policies. And I thought, rather than moving that money, rather than putting it out to work, so we have our money in investments now and we have passive income coming, I'm saying, rather than expand that quickly, I think I'm going to leave what's available in that policy sitting there. And I was telling Patty this on the way to the airport today, or dropping her off to get on the Bright Line to go to Ecuador. And she's like, I'm like, I know it's not our money meeting, which, by the way, we started that meeting on 12/20 of 2022. You know how funny, you guys know Patty, she's messaging you, and I know I'm a little bit all over today, but I've got a million fun thoughts in my head. But when we started that meeting, we'll have to do a whole training on a money meeting. But it was called, I'll have to look up the name. It wasn't called money meeting. It was called something else, money mindset or money something. But we would sit there and just look at each other and be like, what are you talking about? How do you feel about money, honey? She would just be like, what do you mean, how do I feel about money? And all the rules, all the things. Money was the weird uncle we didn't talk about. So it's taken us almost 3 years to really get to the point where we're comfortable and we're actually talking, yeah, that makes sense, or maybe we should keep it moving, or what's the best thing for our family. And so when we're looking at policies as opportunity funds, whether we're saving it for that rainy day, for the emergency, for something that might come up, like Connor's question, or rather than jumping on the first thing we see, as we're paying ourselves and storing it in a policy, it's the opportunity for when something that we really know, like, and understand comes, we know that in our glorified savings account, it's protected, it's growing tax-free, it's away from the government, and, Uncle Sam's not getting at it, and it's guaranteeing our legacy. And for us fathers out there's a lot of dads here and moms, that is one of the best feelings in the world, is when you know that, hey, what I'm doing today, what I'm doing with my money right now, is giving more to my future, and then setting up what that looks like. So what are some of the key takeaways for you today? One for me would be, fix the leaky bucket. Where do you have leaks in your bucket? And we all do. We have leaks in our bucket. Don't think your bucket is perfectly sealed and running 100%, because then you're missing the opportunity cost. You're missing the small places where some money might still be leaking out of your bucket. And sometimes it might make more sense to go do something else in your life before you fix the leaky bucket. But how much would it cost you just to be aware of it? Probably nothing. A little bit of time, a little bit of energy, a little bit of focus. We're just starting 2025. This is your year to find and begin your road to freedom. This is your road to freedom. So control, patch the leaks, have the money working for you, understand the hidden costs. Will you take that toll road or have that leaky bucket continue to drip money out of your life? Or are you going to take the time to understand the cost of money? Again, it goes back to the simple principle that you finance everything in your life. You either pay interest or you're paid interest. You earn interest. So let's make a plan, move towards your big vision. It's totally up to you. And I'm going to love you guys either way, but I'm saying really understand what your money's doing. Get really present with it. Be honest with yourself, because all progress starts and all possibility starts with being honest with ourselves first. So my call to action to you today is simple. You can either, if you haven't talked to me, I saw there were some questions from Shane here, book a call with me, get a strategy. I'll meet you where you're at. I'll help you work through this. Share the webinar. Make sure you're going out and telling people, like the one woman who would walk around knocking on everyone in her neighborhood's doors and letting them know, like, hey, you got to check this out. This is the truth. We've been lied to all these years. Go be that person that's bringing this value to somebody else. If you guys see the value here, make it your 2025 mission to invite 1 or 3 or 5 people. Most likely, nobody's going to come. But if one person comes, think of the impact. You guys should see the messages coming in from all of you every week. We love it. Like, we couldn't be more honored to serve and to help and to receive the feedback that we receive. The more you guys are giving us in feedback and questions, the more answers, the more depth, and the more fuel we get for this. Make sure you're subscribing, engaging, and being here. Shane's going to finance his tools with his assets. I love that. That's one of my goals, Shane. I want a new bike this year. If any of you are cyclists, start riding. We're going to do a 250-mile ride across Florida sometime this year. And Jeanette, do financial advisors know about this? Most of them know. Some do. I've got a guy in one of my masterminds that him and his family have 40 of these policies. He's been a financial advisor for, I think, 30 plus years. So some do, some don't. The guy who actually taught me, my first mentor, is a fiduciary with 40 wealth management offices. And when I asked him for a financial philosophy, he handed me, which you guys all have seen this. This is my Bible for money, becoming your own banker. And what I love about it, it shows our human nature. It shows the 5 things that we have to be aware of to make this successful. And it shows us what the game really is with money. So thank you again, as always. Who do I contact to get started? Monica, you can scan that QR code. Here, I copied this in the beginning. There's my calendar. You can click there too. And as every week, I appreciate you guys. We'll be back with Gabe next week to do week 9, which is the wrap up of everything we taught in 8 weeks. That whole series is out on my YouTube channel, so go watch it. I have a guy going through it. I fixed it so you can click on it, like if you're on your phone, and it'll actually just play them episodes 1 through 8, and we'll get episode 9 up the week after next. But super blessed, super grateful to be here with you guys. It's always fun. I learn a lot from you. Are there companies that allow you to borrow more than what you have in PUA? If you know a bank, Eli, that you can put in $10 and they let you borrow out $15, when that happens, it's because you've had a policy and you've reached your efficiency, and now after you've capitalized your system over time, the uninterrupted compounding, the answer is yes. Later on, you can borrow more than you're putting in. But when you first start, remember, when you put money into bucket number 1, it buys something. What's it buy? It buys death benefit. So you have the guaranteed growth here, the guaranteed death benefit, and then you borrow from cup number 2, which is the general fund of the insurance company. So for the first few years, we talk about how this is a marathon. Thank you for the question. I'll be sharing the WealthWise Banking podcast, so you'll have more ways to follow along. The guy that I'm working with there, Jeremy, he's awesome. He's a spreadsheet guy, ex-Special Forces pilot, West Point grad, so someone that's really dialed in with discipline. He's a real estate investor, so him and I, between mindset and the math, it's really a good marriage, and it's a fun thing to do. So come check that out, and that's it, Monica. The podcast, I'll get it out to you guys. It's on Apple, it's on Spotify, it'll be on YouTube, and I'll see you guys next week. Be blessed. Thanks all. So today we covered why do the banks want to lend you money? Why are they offering you so many 0% things, credit cards, lines of credit, HELOCs, different ways to get you to borrow from them? Have you ever stopped to think about that? The opportunity cost, the leaky bucket, the toll road. That's what we covered today. So if you've enjoyed this, make sure that you smash the like button, you subscribe to the channel, and you ring the bell so you get alerted to new content. We're going to be here in this next video. I will see you there, where we keep talking about how infinite banking and shifting your money mindset is going to give you that feeling of freedom. So be blessed until the next episode, which is right here. I will see you soon.